We are diving deep into the income taxation of death benefits for the national portion of the life insurance exam. You must understand that under Internal Revenue Code Section 101A1, the general rule is that life insurance death benefits paid to a named beneficiary are received income tax-free. This holds true regardless of whether the policy is a term policy or a whole life policy. On your exam, you will likely see a question where a policy owner dies and the beneficiary receives a lump sum of $250,000. The question will ask how much of that is taxable. The answer is almost always zero. However, the exam loves to test the exceptions and the nuances of how that money is paid out when it is not a simple lump sum. When a beneficiary chooses a settlement option other than a lump sum, such as a fixed period or fixed amount, the insurance company holds on to the principal and pays it out over time. During this time, the principal remains at interest. The exam will test your ability to distinguish between the tax-exempt principal and the taxable interest. For example, if a beneficiary is supposed to receive a $100,000 death benefit but chooses to receive it in installments that eventually total $110,000, only the original $100,000 is tax-free. The extra $10,000 is considered interest income and is taxed as ordinary income in the year it is received. Remember the mnemonic PIT, which stands for Principal is Transparent and Interest is Taxable. This simple shortcut will save you from trick questions that try to lump the entire payment into a taxable category. Another critical area for the national exam is the taxation of accelerated death benefits. These are payments made to a policy owner while they are still alive if they are diagnosed with a terminal illness or a qualifying chronic illness. For exam purposes, a terminal illness is typically defined as a condition expected to result in death within 24 months. When these benefits are paid out to a terminally ill individual, they are generally received income tax-free. This is a common exam trap where the question might suggest that because the person is still alive, the money is a taxable gain. Do not fall for that. As long as the medical requirements are met, these accelerated payments are treated with the same tax-favored status as a standard death benefit. You must also be prepared for questions regarding group life insurance provided by an employer. While the death benefit of a group policy is usually tax-free to the beneficiary, the exam often touches on the taxability of benefits when they exceed certain thresholds. Specifically, if an employer provides more than $50,000 of group term life insurance, the exam may look for your understanding of how benefits or premiums exceeding that $50,000 limit are treated. Always look for whether the question is asking about the payout to the beneficiary or the tax consequence to the employee. The exam may also try to confuse you by mixing estate taxes with income taxes. While the death benefit is generally income tax-free to a beneficiary, it might still be included in the deceased person gross estate for federal estate tax purposes if the deceased held incidents of ownership at the time of death. If you see a question asking about the income tax liability of a beneficiary receiving a death benefit, your default answer should be that there is no income tax on the principal amount. Watch for phrases like interest-only option or held at interest. In these scenarios, the entire payment made to the beneficiary is taxable interest because the insurance company has not yet touched the principal. Mastering these distinctions between principal and interest and understanding the specific rules for accelerated benefits and group limits will ensure you navigate the taxation section of your life insurance exam with confidence.